Hi, welcome to this episode of Talking Tax with Alex. I'm really excited to do this one because this is the topic that gave me this whole idea to start doing this channel. I want to dive into this topic, closely held insurance companies, and really give it a good talk. I think it's a really complex and fascinating part of the tax code, and I think a lot of people don't really know about it. But if you do know about it, maybe you've heard a couple things about it. So I think there's a lot of uh, information swirling around out there, and this is one of the things that I practice in as well as a professional. So I'm actually really excited about this topic. This is the original video, the original idea I wanted to do. The other videos I've done so far were kind of warm ups or practices or what have you, but this is the one that I'm really excited about. So, on today's agenda, we'll start with a quick introduction. I'll just quickly talk about what is going to be in this series. We'll go to the series overview, what each video will cover. So, this is going to be a multi video series. Already planned to do that. We'll go just cover the basics. I'll talk about the organization structure and some terminology. And then we'll talk about the IRS's position, their view on things, and the recent action. So there's a recent history to this code section. This whole area of the tax law it's alive and kicking. There's a lot of things going on even in my practice today. And then I'll give a couple closing thoughts. Just what are we going to do? So really quick, this is for section tax section IRC 831B, called closely held insurance company, cheeks, or micro captive insurance companies. So you might have heard just somebody refer to it as a captive insurance company. There's a lot of different ways to say it. I'm putting closely held insurance company or cheeks because then I can put an acronym on it. It's a lot easier to for my diagrams and whatnot. But you might hear me say I might call it a captive. I might call it just an insurance company. In the context here, this is what I'm talking about. So the series overview, I have subdivided this. I plan to subdivide this in 4 parts. Today is going to be part 1. We're just going to talk about the basics, org structure, terminology, and then we're going to talk about the IRS position and recent actions. I then am going to take this into a court case analysis, and we're going to look at, I think we're going to look at one. I have one planned for now, and we might dip into another one. These are landmark court cases that just happened within the last couple of years that are really establishing precedent in this area. So that's why I wanted to take 3 parts on this, because I think there's enough to talk about in the one court case. The one court case I have in mind is about 40 pages. So yeah, I think there's enough to talk about for 3 videos. And I'm going to try to keep the videos relatively short, 10 to 12 minutes. So there's going to be a lot of stuff in there. So we're going to talk about the insurance facts and background of the first case. And then we're going to talk about the taxpayer's facts and background. So we're going to spend a whole video just talking about the taxpayer. And then we're going to spend a whole video talking about the ruling. So this is my plan on how to break up the topics. And so hopefully you get intrigued by the first part and you want to continue watching. I'll make the second, third, and fourth part. And if I need to add an extra part, maybe I'll have to update my plan. But this is my plan right now. So getting really into the basics of a closely held insurance company. Excuse me. Getting into the basics of this. So what does this look like? I drew you a picture. So you have shareholders, you have owners. The circle are individuals. You have somebody who owns a business. They own an operating company that makes widgets, whatever it is. It doesn't matter. They make money. They make something. The shareholders own a business that makes money. And let's say that business makes a fair bit of money. This is a business that's been in place for a while. They may make $20 million in revenue, maybe let's say $50 million in revenue. It's a relatively big business, and they have net profits of like $10 million. Let's just say. So they go consult with their tax advisors and their legal advisors and business advisors. Somebody tells them, hey, you should open up a closely held insurance company. Sounds like a great idea. And the shareholders would go, well, why do I want to open up an insurance company? Why does this make sense for me to own and operate an insurance company? Well, here it is. So in this structure, you can have your operating company pay insurance premiums to your insurance company. up to a maximum of $2.45 million, and this number is indexed for inflation. Your insurance company, so you own this insurance company, and it gives you insurance coverage to your operating company. So you can kind of see how this plays out from a business point of view. Okay, you have your operating company, and your operating company, you go get insurance because your operating company probably already has insurance, right? If you're a business owner, you have to have insurance. But you open up your own insurance company that you own, and it also insures your operating company. So this does seem very self-serving in a way, and you can probably, without me, ripping off the veil and showing you kind of what's happening yet. But this, you can kind of see how this might smell a little fishy or whatnot. But this is common practice. This is a thing. It's legal. It happens. So this is the basic structure. You have your owners. Let's just back it up. You have your owners. They own an operating business. They open up their own privately held or closely held insurance company, and then that insurance company insures for risks up to a maximum of $2.45 million. So here is the perceived abuse, and this is why these structures are under a lot of scrutiny by the IRS. So the premium that your operating company pays to the insurance company is a deduction. You get to take that as a deduction against your taxes for the operating company, and it's an ordinary tax deduction. So it's worth more, and I'm going to get into that in a second, why it's worth more in a second. But that deduction you take at your operating company then pays the premium into the chick, right? And so that's fine. But then this closely held insurance company does not recognize that income. So let's just say it's $2 million for this example right now. So you get a tax deduction of $2 million, let's say in 2022, and then your closely held insurance company picks up that money, and it doesn't have to pay taxes on that money in 2022 or 2023 or 2024 until it dissolves. So that's one big area already. So you get a tax deduction in a year, and you don't have to pick up income in another year. That breaks one of the fundamentals of the spirit of the tax law. Almost always if one entity or one person recognizes a deduction, another entity or another person has to recognize income. So the fact that this exists and is codified in the tax code and all that stuff, it's pretty phenomenal. It's amazing to me that this exists, because you can have your operating company basically paying your own insurance company, taking tax deductions, and not paying tax on that income until you dissolve your insurance company on the other side. And that could be 10, 15 years from now. So you can literally just not pay taxes on that for like 10 or 15 years. That's crazy. Okay, so there's a timing issue. That's already a perceived abuse. And again, it's perceived. I have to highlight, this is a perceived abuse because this is all codified. This is all legal. This is written in the section of the tax code. We'll go in a second. The other issue where this is a very tantalizing tax option is because you get that tax deduction on your operating company as an operating loss. So that's to say you get it against if it's a pass-through entity like I have here, you're getting a K1, and it offsets your ordinary income, which is taxed at the highest marginal rate of 37%. And then let's say in 10, 15 years from now, when you dissolve your captive, your closely held insurance company, you pay capital gains on that income. So that income right now, capital gains is maximum taxed at 23.8%. That's your 20% capital gains plus your net investment income tax, called NIT, 3.8%. So you can already see, like, you get a deduction worth 37% offset on your taxes, and you have to pay tax on that income at 23.8%. So, there's an arbitrage there, right? There's a percentage arbitrage, like 13% or something, 17, I don't know. There's a tax percent arbitrage where you're basically taking a deduction that's worth more than the income that you recognize on the other side. So what's the IRS's position? Well, they're kind of in a bind. It's statutorily allowed by tax code section 831B. This is the tax code section that specifically allows this whole arrangement to exist, because otherwise it's wild that it does. this tax code has been in place since 1986. So this has been here almost 30 years. Like it's been here for a long time. And as recently as in 2017, IRS increased the amount that you could do and you could put into these. So it really increased it from, I forgot what the original amount was, but it was a big amount. I think it went from like hundreds of thousands, like 500,000 to $2 million. So Congress already kind of addressed this and made it even sweeter. They made the deal even sweeter. Here's the IRS's position, though. It's called the reportable transaction history. That's what I named it. So the IRS declared its pursuit of these structures in 2015. What does that mean? Well, they added it to the Dirty Dozens scam list in 2015 because you can see how that tax structure was so sweet and it had so many benefits that there's a lot of people that are peddling it and they're not doing it correctly and they're not really setting it up correctly. That's what the perceived abuse was coming from, is because people were going in a hurry and just basically not following the rules. So in 2016, this is added as a transaction of interest. So that means it's a reportable transaction. You have to report it using Form 8886. You don't really need to know about these forms or anything, but this means that you have to report any advisors. So anybody that sold you the idea. So if somebody said, hey, go set up a captive insurance company, and then they charge the commission, like a finder's fee, to the captive insurance company provider, they have to be reported on this form. So the IRS really wants to know who's promoting this, who's using it. They really want to see everybody that's involved. That's pretty crazy. Then in 2020, the IRS sent out letter 6336, and this was their soft warning that everybody that's participating in a captive is going to get audited. They developed 12 audit tax teams in 2020 to do just that. And as of the most recent development is they have a settlement framework that basically, if you just say, hey, I should have done the captive, I'm sorry, IRS, they will reduce your penalties by a fair bit. So the IRS is really after these things. And you can see since 2015, they have, it's taken them a couple of years, but they have actually, set out the audit teams. I've seen it in my practice. The what the IRS is asking for is like 3 pages long of information. It's crazy. So, there's a lot going on behind the scenes with these because of those tax benefits. Remember, you basically get to take a deduction this year and don't get to recognize income on it for however many years your captive remains active. And then you get to recognize capital gains on it. So you basically get a double whammy of tax benefits. You get a deferral and a tax savings. It's crazy. So that's it for this first series. My closing thoughts are that closely held insurance companies have great tax advantages. And if you're in the position and you're a business owner and you're looking for tax strategy saving, it might be something worth considering. But just note that they are under intense scrutiny. So it's very important to understand the risks of what you're getting yourself involved in, and that you need to really know who the insurance providers are, who your advisors are, and that your advisors understand what this is. It's very important that all of this happens. So I usually have consult your tax advisor as my last line here, but I think you really need to consult a specialized tax advisor, somebody who's practiced in this and knows what captive insurance companies are and knows what the good and the bad ones are. And hopefully with this series, as we go into what the court case where the IRS, they won, I'm just going to spoil it, but we go in the court case, the IRS won and basically defeated one of these structures for a taxpayer. We're going to really see why this happened. And because the rules are very important when this kind of tax law and tax advantage for taxpayers exists. So that's it for this video. If you like the video, if you like this content, please like the video, subscribe to my channel, and comment or email me your thoughts. I would love to hear your thoughts on this one. And that's all I have. Thank you. Bye-bye.